Thank you for tuning in and welcome back to Real Estate Facts. In today's episode, you'll learn about what is a debt to income ratio and why it matters to you. My name is Andrew Finney. Please consider me your real estate geek. I'm always here to help. If you need help finding a top agent where you live, or if you simply want to drop me a line to say hi, my contact info is below. Feel free to hit me up. Love hearing from you. If you haven't already done so, please go ahead and subscribe to this channel now and like this video. Thank you. So let's lead in with first defining what is a debt to income ratio. A debt to income ratio is often abbreviated as DTI. So when you hear DTI, it means debt to income ratio in this sense. And what it is it's a percentage of a consumer's monthly gross income that goes towards paying down debts. More specifically, as it pertains to home loans and mortgages and such, a lender is going to take a look at what your future principal, your interest, your taxes, and your homeowner's insurance combined, and how that pertains to you and how that affects your overall situation, your financial situation, with your ability to repay a loan. It's called a debt to income ratio, and it's extremely important whenever it comes time to getting your home loan and knowing how much home you can actually afford based upon your debt to income ratio. So you might be thinking right now, hey, you know what, my finances or my business, I like to kind of keep them on the down low, and that's cool. You know, in most cases that'd be a great idea. However, when it comes to getting a home mortgage, financial privacy kind of goes out the window, because before a lender can give you a loan, they need to have a clearer picture and understanding of your overall financial situation, what's coming in, what's going out, what you have stashed away, maybe in retirement accounts or mattress money or whatever you may have. So you might be thinking, well, why all the privacy invasion and what's going on with this? And it's because lenders need to make sure that you're not spending more than a certain percentage of your income on your housing. Kind of like your parents, lenders really would like you not to get into a financial difficulty and not have the ability to repay your loan. So this is actually a benefit to you in learning more about the debt to income ratio and why lenders scrutinize those numbers so much to make sure that they're able to give you a loan within a certain amount of your gross monthly income. So you might be thinking, okay, that's great, Andrew, but how do I calculate a debt to income ratio? And that's a great question. So to consider how to calculate a debt to income ratio, let's think back to like grade school when we were learning about ratios and fractions and percentages and how to convert those numbers. So for example, if you have like a 3-to-4 ratio, a 3-to-4 ratio equals a 3/4 fraction, a 3/4 fraction equals 75%, right? So it's important to know that also you're going to have two types of debt to income ratios. You're going to have what's called a front end debt to income ratio and a back end debt to income ratio. Welcome to the world of lender math and debt to income ratios, right? So the easiest way to think of your front end debt to income ratio is like your housing ratio. So if we call it our housing ratio, it'll help us keep things in perspective. So now imagine where you would have a fraction as the top number of is your monthly cost for your home that you hope to buy, and you figure in the principal, the interest, the property taxes, and homeowners insurance. And that's also, by the way, what lenders mean when they say PITI or pity. It's a pity that you had to pay it, I guess. So PITI stands for principal, interest, property taxes, and homeowners insurance, okay? And then you also have to add in if you live in a flood zone area, if you need flood zone insurance, earthquake insurance, and then also if you're putting down less than 20% on your home loan, you're more than likely going to have some form of a mortgage insurance. So it's all those numbers combined into the front end or your housing ratio, your front end debt to income ratio, right? So if we think about it like that, let's put the PITI, which is the monthly cost of your prospective home, on top, and then let's divide it by the total household income. So if you're buying a home on your own, then you're going to have that one source of income unless you have multiple streams of income, and your lender will ask you about that to help you out as well. But if you're a married couple or if you're buying a home with somebody else, then everybody's income, fortunately, is going to be included in that household income. So it can actually help your debt to income ratios as well. So the bottom part of the fraction sums up all of the income that you have coming in. And like I said, if you have a spouse, if you have a partner, if you have somebody else you're buying the house with, then all the salaries are combined into that. So then the bank is going to request transcripts of your tax returns to verify everything. It does an analysis on it, and then comes the math of actually using that ratio to start factoring things out for your housing cost or your housing ratio in this sense. Ideally, there are certain percentages that they'll keep in line with certain type of loan programs. I'll go ahead and give that to you right now as an example. So right now, 2018, you're looking at VA loans with a front end debt to income ratio of 45% and a back end ratio of 55%. FHA loans are also a 45% front end ratio and a 55% back end ratio. USDA loans are a 45% front end ratio and a 55% back end ratio. And a conventional loan right now is around 45% as a front end debt to income ratio with a 50% back end. So to learn more about that, please contact your local loan officer to see how that specifically pertains to you. In some cases, they can actually increase the back end ratio depending on mitigating circumstances and extenuating circumstances that pertain to you. So then let's talk a little bit more about the back end debt to income ratio. As a second ratio that a lender is going to take into account all of your debt, meaning all of the proposed housing expenses plus other things like long-term debt like student loans, car payments, credit card debts, home maintenance, child support, installment loans, alimony, anything and everything that's a debt that you have associated with you, your back end ratio is going to be included in that. So it doesn't include, and it's important to know this, it doesn't include things like groceries or anything that's not going to show up on your credit report. So no groceries, no gas, none of those type of things are going to be included in that number for the back end. So going back to those numbers we were talking about a moment ago, if we look at our front end ratio and we're talking about an FHA loan, when we know that you can have up to a 45% debt to income ratio based on your housing cost, right? And you can have a back end ratio. So after we factor in all the rest of your debts with your credit cards and car payments and any child support or alimony, installment loans, student loan debts that got to be included, then that's why that back end ratio is going to be a little bit higher. So going back to the FHA loan example here, it would be like 55% on the back end. So that's some really good stuff for you right there. And it's actually really good news. So what's going to happen is the lender's going to take your overall number, and whenever they calculate out that front end and that back end ratio, they're going to say, hey, guess what? You're approved to be able to buy a $300,000 home. And with that $300,000 home, it's because you're earning $75,000 a year, for example. It's just kind of giving you an easy way to understand what it takes to buy a $300,000 home. It's about $75,000 in gross income per year, depending on your debt to income ratio. Anyways, if you have any questions about this, please feel free to reach out to me. I'm going to put my contact information up. I absolutely enjoy hearing from you. And keep in mind that the best source of information for anything to do with debt to income ratio on home loans is a local loan officer. So they'll take the time and explain it, and they'll take the time to share with you how your debt to income ratios impact your borrowing power and what you can do to increase it if you want to do that as well. So if you haven't already done so, I'm going to ask you to do 3 things. Number 1, please subscribe to this channel. Number 2, please like this video. Number 3, please share this video around with someone you know is going to be able to help. Thank you so much for watching today, and between now and next time, I'm wishing you and yours a lifetime full of love, wealth, abundance, and happiness. See you soon.